Today, 50 million digital creators drive a $250 billion economy. A single viral moment can turn a 20-year-old into a millionaire overnight. But while modern wealth is moving at the speed of the internet, the IRS is operating on tax codes written decades ago. For athletes securing endorsements or breakout stars hitting peak virality, the bulk of their lifetime earnings might compress into a tiny window, sometimes just between the ages of 18 and 23. Without an immediate understanding of how that money is taxed, a creator can easily spend their gross income, only to face an unpayable tax bill in April that wipes out their early wealth. Surviving this industry requires anticipating tax traps most people don't see coming. That is why Arc and Ledger Accounting, based right here in Culver City, specializes in shielding modern creators from an outdated system. Let's start with a dangerous assumption. Many creators believe that if a brand doesn't deposit cash directly into their bank account, the compensation isn't taxable. Say you accept a crypto payment for a sponsored post. Even if you only receive a fraction of a Bitcoin, the IRS requires you to report its exact fair market value in US dollars at the precise moment of the transaction. The same rule applies to luxury PR boxes. If a brand sends you $5,000 worth of products in exchange for promotional content, that is not a tax-free gift. Look at this IRS tax treatment table. It clearly classifies those PR boxes as non-employee compensation. Crypto payments are similarly flagged for reporting. Treating luxury products and crypto drops as free perks creates a significant unbudgeted liability. If the IRS audits the brand that sent those gifts, your name is on that 1099, leaving you with a bill you never saw coming. The next trap lies in categorization. This table compares ordinary income with royalty income. How you classify your revenue determines exactly how much of it the government gets to keep. Here we see a standard Schedule C for business profits. If you classify brand deals as ordinary earned income, you are subject to heavy self-employment taxes on every dollar shown. When NIL rights are properly structured as royalty income on Schedule E, that revenue can often be treated as unearned income, potentially exempting it from the 15.3% self-employment tax. This requires a specific legal framework, but it is a primary tool for protecting high earners. There's an additional catch regarding qualified business income deduction. The IRS categorizes most entertainers as a specified service, trade, or business, which heavily restricts the deductions you can claim. If you don't have an expert routing your revenue streams into the correct buckets, you are needlessly handing tens of thousands of dollars back to the government. For touring artists and traveling athletes, this new geographical freedom creates a massive blind spot: accidental out-of-state tax liabilities. Aggressive states use the jock tax to target non-residents based on duty days worked inside state lines. If an athlete spends 10 days of a 200-day season playing in California, California claims the legal right to tax 5% of their entire annual salary. Failing to track your travel meticulously means facing harsh penalties and double taxation from authorities actively looking to collect their share. Traveling to build your brand is essential, but without precise location tracking, your mobility becomes a massive financial liability. Surviving the creator economy means moving away from a reactive scramble every April. You need a proactive tax architecture operating year-round. Defensively, that means tracking your duty days across state lines to minimize exposure and executing careful residency planning. Offensively, it requires a highly aggressive income deferral. Tools like solo 401ks and SEP IRAs let you lock away capital now, stretching a short, explosive earning window into lifelong wealth. These digital-first revenue streams are moving faster than the tax code. Navigating NIL rights, crypto compensation, and multi-state jock taxes requires a specialized focus that general tax practices often aren't built to maintain. Don't let a lack of preparation cost you your success. Partner with the specialists at Arc and Ledger Accounting and build the architecture to protect your modern legacy.